Today is Monday, January 6th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, ADM Investor Services Senior Financial Economist. Steve, let's start with the grain markets this morning. Have grain futures corrected an overbought position, and are they now ready to trend higher into the January crop report? And how will the market be influenced if a new Phase 1 trade deal between the U.S. and China gets signed on Jan 15?
Well, I think we have to take each market separately. I think the bean market has corrected from an overbought situation. We sold off because of the tension in the Middle East, and I think now we're trying to build a base going into Friday's USDA report and also into the Phase 1 deal, because China could start buying beans as soon as the deal is signed. As far as the corn market is concerned, we continue to drag along season lows. We don't have the export pace. I think the only thing that could rally corn right now would be if China starts buying corn or corn products from the U.S. because of the deal. And I think the wheat market has made a top. I think that we've been rallying because of tightness in U.S. and European supply situation, but 2020 should be a record year for wheat, and I think wheat markets need to trade lower. As far as the deal is concerned, it's the 30-day implementation period before China buys. We don't know what they're going to buy. We don't know when they're going to buy. So I think that that'll be kind of like buy the rumor, sell the fact, in that we're kind of gearing up for that a little bit, and then once the deal is signed, the market might back off a little bit.
That was my next question. So yeah, I think that it stands to reason that, when a big news story like this gets beyond us or behind us, the market may sell off a little bit. They start looking at the numbers again in regard to supply and demand.
At the USDA report, the WASDE is not going to increase U.S. exports because of the Phase 1 deal, and I think that might be a little disappointing to the demand bulls.
Finally, Steve, do you have an early outlook for grain futures in 2020?
We always have to assume normal weather, but I think if we have normal weather, prices will eventually trend lower. We might see a little bit of a bounce from a Feb low into a May high because of weather uncertainty, and China might be buying a few things. But if the weather's good, we'll make a top on July 4th and work lower into the fall.
And looking at some of the other markets, in a flight to safe havens move, gold soared to a 6-year high and silver hit a 4-month high.
Right.
If and when the situation in the Middle East settles down, will the precious metals continue to advance?
Well, yes, I think they will, and we ultimately will go back to the fundamentals that have been dominant prior to this flare-up of the problems in the Mideast, and that is the central banks around the world over the last couple of years have been very big buyers of gold, and also we have the low interest rate environment that is very supportive, plus now we have the added bullish influence of commodity price inflation. That would be industrial commodities. So all of these factors, I think, will ultimately continue to dominate to take the precious metals higher.
What's the outlook for the 30-year Treasury bond futures?
Well, that one is a little more unclear. In fact, I don't think that the bonds is where we would like to focus our attention right now. Central banks this year are probably not going to be as active as they were last year in their policy moves. There's a slight bias toward easing. So I think there are better places to be than in the interest rate futures markets. That would, of course, be the industrial commodities, stock index futures. But the bond market, I think, is one to stay away from.
Due to the fact that there's going to be a lack of volatility, a lack of trade in that market, you feel?
I do. Of course, there's always the flight to quality influence, and that's very unexpected. And of course, that was an influence over the last few days. So I think, though, that the bonds will be trading in a very, very broadly trade range with breakouts failing in both directions.
Now, how are the stock indexes being affected by the heightened Middle East tensions, and what should we look for over the next few days and weeks?
Well, they were, of course, very adversely affected by the events of the last several days. But I think that ultimately, when things settle down in the Mideast, that traders will again focus on the interest rate influence, which has been very bullish, in fact, over the last 10 years or so or more. So it's the interest rates that will once again dominate to take the indices higher. And I think January will be an up month in spite of the pressure we are seeing today.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.